everyone, this is Dr. Vara Lakshmi and I'm going to be discussing you regarding the problems and the practical elements related to the break-even point as well as the break-even analysis, and the more solved problems are going to be discussing in this particular video. So first of all, the break-even points. Before going to have the knowledge on this break-even point, let us have the discussion on the cost as well as the profit relationships in any production. For any product, if they wants to fix the selling price for a product, for example, the selling price of a product is, assume that it is 100 rupees, means it is the combination of the cost plus their profits. So which means to produce this any product, assume that there is 80 rupees of the amount has spent for the product. Then if they are expecting 20 rupees as the profit, the combination of this cost and the profits will be called as the selling price, or selling price is including of the cost plus profit. And moreover, the cost means the expenditure which is incurring in producing of a product, or the cost which is incurring to transform the inputs into the desired outputs is called as the cost. That again categorized as opportunity cost, fixed cost, variable cost, overheads cost, various categories of that one. In the theory, already we have the knowledge on that particular related cost and everything. And every positivity or the prosperity of the business, we expecting the profits. And there is no rule that all the time the business people has to get the profits. If it is below that cost, for example, if they have sold this price instead of 100 to the 70, now the selling price is less than the cost of that product. So which means they got the loss. So that means if the selling price of any product is less than the expenditure which is incurring on that product, then we can say that it is a loss. But in a prosperity way, we always seek that the selling price should be more than the cost. So in this one, to have the margin between the loss and profit, they should know what is the point at which where there will be a no loss or the no gain point. So that if they would have known this particular point, then the business can be analyzed. Are they in the path of the profits, or are they in the path of this losses? So to have that knowledge, and that too, why aren't we, it is easy to calculate that cost means, so cost is not same, or cost is not only the one terminology for all the products. So for this products, so sometimes they have to add the overhead, sometimes they have to add the labor, sometimes they need to change this machinery, so overheads cost, logistics, transportations, opportunities cost, the interest rates which they are paying for that funds. So many costs are including in this expenditure or in the process of transforming this inputs into the output. So that's why it is mandatory to have the knowledge on the break-even analysis by considering all the expenditures which is incurring on that particular produced product. So that's why to have the knowledge on the whether are they in the successive path or in the losses path, there must be a milestone point has to be calculated. That milestone point is called as the break-even point. So in this entire session, in practically, how this break-even point will be calculated, that we are going to be discussing. So in terms of units, we can say, in terms of the sales, we can say, for example, so if this is the 20 rupees of the profit for one unit, if they are all getting, if they are expecting the 100 rupees as the expectation, then how many units they have to sell means, for each unit 20 rupees means they may have to sell 5 units. Then this is the expectation of that one, or at least what is a break-even point means 80 rupees. 80 rupees per unit is the break-even point. Cost incurring on that one is 80 rupees, because at the break-even point The profit will be 0, losses will be also 0, means cost. So here 80 means if they wants to if they have totally spent 800 rupees on that particular production, means at least they have to sell 10 number of units to cover that 800 total number of expenditure which is incurred for that productional processes. So here is, I have discussed with you in terms of these units here, 10 number of units. And here I have discussed with you 800 amount, at least 800 rupees of the amount if they have incurred, then only they can cover that expenditures, or there will be at least they won't get the losses, or they may not be getting of the profits. So that for that calculation purposes, some formulas are formulated for the easy calculations, such are contribution is equals to sales minus total variable cost, and profit is equals to contribution minus fixed cost, and break-even point is equals to fixed cost divided by profit volume ratio, whereas the profit volume ratio means we can calculate with the help of contribution divided by the sales, and MS stands for the marginal safety. So margin of safety will be calculates with the help of profits divided by profit volume ratio. Here, another terminologies we are going to be seeing, that is fixed cost and variable cost. Mainly, whatever the terms of what are the number of the costs are all there, that may be the labor cost, material cost, rent, etc. Whatever these expenditures are all there, they are all categorized as two elements. One is the fixed element, another one is the variable cost. If any expenditure incurring by the organization doesn't changes as per the output, but changes as per the time period, then such cost will be called as the fixed cost. For example, in our house, we will pay the rent. Even we are all staying 2 members, 3 members, any of the holidays, if we went for any vacation also, we will pay the same rent. But as per the time period only it will be changes, but not as per the strength it will be changes. Such cost will be called as the fixed cost. Whereas the variable cost, so milk we are consuming, or the groceries we are all consuming, food item, everything will be differs from one person additionally adds, again the consumption of these groceries, milk, every food items will be changes. If one person reduces, again it will be reduces. So that means if that is changing as per the number of members, that if for the production also, if the cost is changing as per the number of units, then such cost will be called as the variable cost. For example, labor. The labor working hours basis, the companies, organizations will pay the wages to them. If the labor is working for 5 hours, some certain type of wages. If they are working for 4 hours, or the wages will be reduces, which means, so these are all varying based on if the people will works for 4 hours, 100 output, assume that if they works for 5 hours, there is a chance of 120 articles production. So which means the number of time period or the labor cost which is incurring on that labor will be having its impact on the number of outputs they are all producing. Such cost will be called as the variable cost. And 2 kilos of the raw material is using for the production of any product, means if the 2 products has to produce, 4 kilos they have to use. If they are producing 10 into 2, 20 kilos of the material they have to use. Again, that material cost will be called as the variable cost. But if the rent which they are all paying for that particular storage capacities, or any expenditure which is incurring for the machineries, transportation, again somehow the transportation costs are a combination of fixed cost and variable cost. So for example, petroleum per liter and per kilometer it will be changes, and the standard cost which they have to pay for the organizations, that will be some fixed. It is a combination of that. Such cost will be called as mixed cost. So this one will be categorized as fixed cost and the variable cost. So totally, for example, if a product is product's cost is 10 rupees for any product, 10 rupees is the expenditure. Out of this one, 3 rupees they are spending as a variable cost means for that particular 1 unit of the product, exclusively they are spending 3 rupees, which means for the covering of this fixed cost, it is going to be contributing 7 rupees. This assume that 5,000 rupees of the fixed cost rent which they are all paying. Rent is for the entire units. They can't segregate this rent we are paying for this 1 article only or 10 articles only. For all the total products produced in that particular area, they are spending that particular rent. So from each unit, if the labor cost, variable cost, overheads cost, everything, if they have removed that one, so 7 rupees is the contribution they are all acquiring from that particular product. So this is the total fixed cost they have paid, and 5,000 divided by 7. If we divide this one, then we will get in terms of this number of units. Because this is a per unit basis. Per unit basis. 7 sevens are 7 ones are 7 fours are. So points. So 71.4. 714. So I'm sorry, 714 number of units if they have to sold, they are able to sold. Then with each unit price of 10 rupees, then there is a chance of recovering this 5,000 rupees of fixed cost as well as 3 rupees per unit variable cost, so that the organization will get no profit and no loss. So this is going to be calculating. So that's why same here is also contribution means sales minus the total variable cost, so that the profit will be equals to the contribution minus fixed cost. See here, for example, already we have seen the sales is equals to cost plus, cost means fixed cost plus variable cost plus profits. So anyhow, if it is a break even means it is 0. Then sales minus, if we send this variable cost to this side, then it will be called as the fixed cost, plus profit is 0 means break even point. So break-even point in terms of the units, we can say if the sales are all in terms of the per unit, if they are all per unit basis. Then BEP unit is in terms of the unit is equals to this term is now we are calling it as the contribution. Now we are calling it as a contribution, so that BEP units is equals to contribution minus fixed cost. Profit is equals to contribution minus fixed cost. So like this, the formulas are derived from the theoretical aspects of this break-even analysis. So let us move on to this practical problems related to this one. The first thing is, if the sales is equals to 40,000 and the fixed cost is 7,500 and the variable cost is 17,500, and find the following, that is the contribution, profit, break-even point and margin of safety. So the meaning of this margin of safety means more than the break-even point, whatever they have achieved, that is called as a margin of safety. For example, break-even point is at 100 rupees. They have received 120 rupees means they are at safety point of 20 rupees. They are safety of 20 more than the break-even point. So that's why actual sales minus BEP sales, if we have discussed, then it will be called as the marginal sales. From this given data, we need to find out these 4 elements. So with this one, we are going to be using this kind of the formulas, that is contribution is equals to sales minus variable cost. So sales is 40,000, whereas the variable cost is 17,500. So that we will have the conclusion of 22,500 as the contribution. Then the next point, they asked us to calculate the profit. So now we know that one profit is equals to contribution minus the fixed cost. Contribution we have calculated as 22,500 minus the fixed cost of 7,500, that is equivalent to 15,000 rupees. Then next one, the third element, they are asked us to calculate the break-even point, BEP, that is equals to fixed cost divided by profit volume ratio. So profit volume ratio means out of the total sales, the ratio of the contribution provided by that particular product will be called as the profit volume ratio. So here the profit volume ratios, how to calculate means contribution divided by sales. So contribution we have calculated as 22,500, whereas the sales is equals to 40,000, that is equals to 0.5625. That means out of their sales, 56.25% of the product is contributing towards the profits. That is profit volume ratio. 25% it is contributing. So that to calculate this BEP, fixed cost of 7,500 divided by 0.5625, that is equals to 13,333.33 rupees. This is the amount in terms of the amount. Because in terms of the units we have to calculate, we must know the break-even selling point of 1 unit and variable cost of 1 unit. If they're not given the total sales in terms of the amount they have given, then the resulting point will also be in terms of the BEP in terms of amount. If they have given this selling price separately, then we can easily find out this BEP in terms of the units. Then the next one is fourth one, they asked us to calculate this margin of safety. As we know that one margin of safety is equals to BEP sales minus actual sales or profit divided by the P by B ratio. So the total profits of this organization for this with this given data we have calculated as 15,000, that is divided by, whereas the PV ratio is 0.5625, that is equals to this 26,666 rupees of this benefit they have received. So like this we can calculate easily if we have the theoretical support and how these formulas were derived, then it is very easy for us to analyze this one. The second model of this break-even point analysis, if we see, Bansi company manufactures a single product having a marginal cost of 1.5 rupees per unit, with a fixed cost is 30,000 rupees per annum, and the market is such that up to 40,000 units it can be sold at a price of 3 rupees per unit. By any additional sale must be made at 2 rupees per unit. Company has a planned profit of 50,000. How many units must be made and sold? So this is the information which is provided for us. Then if we see, first thing is contribution desired. So contribution, how much of contribution we are all desiring means fixed cost plus desired profits. So here contribution is always depends on this sales. If they have given, then we can directly calculate that one. Contribution is equals to sales minus variable cost, but that is not given. But contribution, how much they are expecting means it should cover both the fixed cost plus the profits of that one. So in this given data, fixed cost of 30,000 rupees, fixed cost of 30,000 rupees and up to 50,000 rupees of this amount, they are all 40,000 number of units. 40,000 number of units into 1.5 is equivalent to desired profits is expecting up to 50,000 rupees of profits, that is equivalent to 80,000. So 80,000 rupees is the contribution desired by the organization. Then we need to calculation of the contribution by producing 40,000 number of units is equals to contribution per unit minus selling price of each unit minus marginal cost. So selling price of this each unit is they have given 3 rupees, out of which the expenditure which is incurring on that product is 1.5 rupees. So that 3 rupees minus 1.5 rupee, that is 1.5 rupee as the contribution for the producing of 40,000 number of units. Next thing is contribution for the producing of 40,000 number of units is equals to contribution by producing 40,000 units. They got 1.5 rupees as the calculation into 40,000 means that is 60,000 rupees is the contribution for the producing of 40,000 number of units. And the next thing is additional units to be produced at and sold at 2 rupees per unit after 40,000 units means so 80,000 rupees of the contribution they want, and out of which 60,000 rupees is already they have calculated for the 40,000 number of units means additionally if they want to sold it for 2 rupees or instead of the 3 rupees it should be 20,000 rupees, because here the desired profits company is planning to expecting the desired profit of the 50,000. So this 50,000 they are all expecting with the fixed cost 80,000 total they wants to contribute for that product, and with this product for up to 40,000 units if it is 1.5 rupees means up to the 2 rupees it is they need to get 20,000 rupees as the benefit, and units to be produced for the contribution of 20,000 after change in the price is equals to because 20,000 number of units is added, 20,000 rupees of the amount is added for this increased number of the sales, then 2 rupees per unit minus 1.5 rupees of that amount we have calculated, that is equals to half rupee is the benefit out of this one. So for this additional units to be produced for the contribution of 20,000 rupees is equals to 20,000 into 100 divided by 50. So that we got the 40,000 number of units. So total number of produced to earn a profit of 40,000 plus additional 40,000 number of units they wants to produce means total 80,000 number of units they have to plan to get the to get the expected earnings out of this sales. The next one, third problem, if we have to discuss, that is the Mitanshi and company manufactures 3 products. The following is the cost data related to the products A, B and C. Now, products are 3 and they have given this sales data, variable cost, contribution and fixed cost as well as this profit details of that one. So with this knowledge of this marginal cost, we need to interpret the data to help the management in changing the sales mix in order to increase the profit of the company. So let's find out this relative profitability so that we can compare it later on this particular element. So first of all, sales 1,50,000 per A, for B 90,000, for C 60,000. So total is 3 lakhs. But once if we see this variable cost, if we less this variable cost from the sales, the contribution of this particular A is 30,000 and B is 27,000 and the C is 24,000. So even if we see this sales, there is a maximum sales are all there for A. But if you see the contribution incurring by this one is very less comparison is there between the A, B and C products. And so total fixed cost is 40,000. Total amount is 81,000, and if we less this 40,500 of the profits fixed cost, then we will get a profit of 40,500 means. So P by V ratio of this A is 20% and P by V ratio of B is 30% and P by V ratio of C is 40%. How it is calculated means contribution divided by sales. So P by V ratio is equals to contribution divided by sales. So by having that formula, they have calculated this P by V ratio. So contribution 30,000 divided by 30,000 divided by 1,50,000 into 100. 20% of the contribution from A. If we see, out of this 90,000 sales are 90,000 only, but the contribution from that particular unit is 27,000, which means they are going to be get 30% of their contribution towards that one and 40% towards that sales. Out of, they have spent only 60,000, but they have received 24%. Even if we have seen here 60,000 is the less amount, sales 60,000 is the less amount they are all getting, but the contribution from that one is 27,000 rupees of that one. So which means, so from the above table, it is clear that with the comparison of the product B, A and C, keeping total production as the same, company should change the sales mix in a way that emphasis should be on producing product C and B more than A. So if they want to go for the sales or a maximum beneficiary to the organization, it is keep on to change this maximum. Let us say if they want to produce 100 articles of total combination of A, B and C, maximum priority they have to give to C, and medium priority they need to give to B, and minimum priority they need to give it to A because of its profit volume ratio contribution towards this product. So now we are let us assume that the company decided to use its production capacity more for the product B and C than A. So let us see what will happen to its profit levels if the sales of this product B and C is increased by 30,000 and the product A is reduced by 60,000. So we will check what is it's going to be having its impact. So assume that 1,50,000 worth of this A sales are reduced by 90,000, whereas the B sales are all increased from 90,000 to 1,20,000 and C sales are increased from 60,000 to 90,000. The total is 3 lakhs and variable cost is 72,000, 84,000 and 54,000 respectively with the reduced values, so that the contribution is 18,000, 36,000 and 36,000, so that the profit levels of this organization is 49,500 if we less this fixed cost of this one. So here the profit levels are all only 40,000 and 40,500, but here if we have seen the same fixed cost but the different combination of that one, they increase their profit levels from 40,500 to 49,500. So this is the impact of the calculation of the break-even point to have the or to decide the sales mix of the product which are contributing maximum profitability to the organization. There's some more examples. If we see this one, the unit 4, a company has a machine number 9 which can produce either product A or B. The cost data relating to machine A and B are as follows. That is, product A's cost is selling price is 20 rupees, product B's selling price is 30 rupees. And the variable expenses of this A is 14 rupees, so that it is going to be contributing 6 rupees towards the profit levels. And whereas the B's product variable cost is 18 rupees and it is going to be contributing 12 rupees for the production. Then additional data they have provided is capacity of machine number 9 is 1,000 hours. It is going to be working for 1,000 hours, and in 1 hour machine number 9 can produce 3 units of A and 1 unit of B. So it can produce in 1 hour, it can produce 3 units of A and it can produce 1 unit of B. So which product should machine number 9 produces, either A or B? So whatever the product is having the maximum profit volume ratio, then it is better to choose that one as the maximum one. So statement showing the contribution per hour or for machinery 9A if we have seen. So generally for product A, it is 20 rupees per each unit, and for product B 30 rupees. So same as 20 and 30. If we less this given variable expenditures of 14 rupees and 18 rupees respectively for A and B products, then we will get the contribution of 6 rupees and 12 rupees. Contribution per hour. Contribution per hour is 18 and 12, because in 1 hour, machine number 9 is producing 3 articles of this product A, and whereas it is going to be producing 1 article of product B. So which means for each per hour, they are going to be contributing 6 means. So the 3 articles it can be produced. So 6 into 3, 18,000 rupees of amount they are going to be contributing towards the sales. Whereas per hour, the contribution is 12 rupees because they are going to produce only 1 article. So here per unit 6 rupees means per hour 3 articles they are producing, so that 18,000 rupees of that contribution they are going to be giving for this 1,000 units, and it is going to be contributing 12,000 units. So from this above, it is very clear that it should be produced product A with the help of this machine A than the product B, because it is going to be contributing maximum towards this 1,000 number of units. The next one, if we next example problem, if we want to discuss. So Meat and Company Limited has 3 divisions, each of which makes a different product, and the budgeted data for the next year is as follows. So they have given the 3 divisions A, B and C, and the sales data is again they have provided, that is 1,12,000 of A product, 56,000 of the B product, and 84,000 rupees of the C product. And direct material cost for the respective ABC is 14,000, 7,000, 14,000, whereas the direct labor cost is 5,600, 7,000, 22,400, and the variable overhead cost is 14,000, 7,000 and 28,000. If we have seen this one, these 3 will be called as the total variable cost, so that sales minus the adding factor of these 3 elements will give us the contribution. Then contribution minus fixed cost, we will get the profits. But they have given this fixed cost of this different divisions of this A, B and C, and the management is considering closing down the division C. This is there is no possibility of reducing variable cost. Advise whether or not division C should be closed down or not. So by having this data, we have to give them is it closing of the division C is profitability for them or not even the cost beneficiary for them or not. We have to give the solution for them. If we see this one, the marginal cost statement of this particular unit, division A sales are 1,12,000, whereas the combination of this direct cost, marginal cost like direct material, direct cost, variable cost, totally 33,600, so that we got the contribution of 78,400 rupees. And B is 56,000 rupees of sales they are all incurring, but marginal cost is total 21,000, which is equals to 35,000 rupees, and 84,000 minus 64,400 rupees means 19,600 rupees is the contribution of this division C. And fixed cost is if we less this fixed cost, and profit is 50,400 from A and 21,000 B, and they are going to be get this 8,400 rupees of negative one, that is loss, because contribution is 19,600 only, but additional fixed cost of 28,000 they are going to be incurring. So it is better to close down the C, because they are going to be getting the loss of 8,400 with this particular division. So it is better to continue this A and B divisions are only, but due to this running of this division C, the organization is going to be getting the losses. The next one, sixth model problem related to this break-even analysis, if we see. Cost data for the last 5 years is sales is equals to 60 lakhs, operating at 75% of the capacity, and marginal cost operating at 50% of the sales is equals to 30 lakhs, and the contribution is 30 lakhs. So that obviously sales minus marginal cost, that is equals to the contribution of 30 lakhs and the fixed cost of 20 lakhs. So that contribution minus fixed cost, the profit levels are all 10 lakhs. Percentage of profits over the sales are 16.7%, and a report on this performance for the year states sales of 80 lakhs and profit of 16 lakhs, and percentage on profit on sales is equals to 20%. Should the performance of the current year be commended, what option should be conveyed to the manager, directing on the basis of cost volume profit ratio? Now we have seen they have given the operating at 75% capacity. Now we need to compare with if it is fully operates, what is its profitability ratios, and if it is operates with a 75% of the capacity, what is its sales analysis. We will compare that one. Based on that one, if we can give the interpretations to the manager. So that's with this one, last year performance, 75% capacity sales there, it was 60 lakhs, and whereas in the presently 100% capacity means 80 lakhs they are all expecting. And some next thing is marginal cost, 50% of the sales means, so see, out of the 60 lakhs, 50% marginal cost means 30 lakhs and 40 lakhs, so that the contribution is 30 lakhs and 40 lakhs. And fixed cost of 20 lakhs, if we less from this one, 10 lakhs profit was there in the last year, and this year they are going to be get 20 lakhs. So actually they have increased the 25% of the production capacity, because 75% performance is increased to 100%. 25% if they have increased, they are going to be get 100% benefits. 10 lakhs has become double. So sales operating profit ratio has increased as 100% profit. So with the 25% of this increased capacity, there is a chance of increasing 100% beneficiaries with this particular sales. So that is about the analysis we are giving to this organization. If they are able to increase the 75% of the capacity, then there is a chance to increase the 25% of this capacity. There is a chance to increase the 100% profitability towards that product. The following budget has been prepared at 70% level of the home markets. Home market means we can assume that it is an India. The number of units that are selling in India is 4,200, and the wages amount is 12,600, and materials cost is 21,000, whereas the fixed cost is 7,000 and the variable cost is 2,100. The selling price in India is 15 rupees. And in Sri Lanka, it is about 800 number of units that may be sold, and only at 10 rupees only. And in addition, 25 paisa per unit will be expenses as freight, etc. So do you advise trying for the market in the Sri Lanka? If we see particulars of this given data, in India, the organization has the desirable number of units is 4,200 units. It has a demand for 4,200, whereas in Sri Lanka they can sell this 800 number of units. Total number of units they are selling is 5,000 number of units. Sales can be always units into selling price per unit. In India, the selling price will be 15 rupees, whereas in Sri Lanka the selling price will be 10 rupees, means 15 into 4,200, that is equals to 63,000 rupees of this amount they are going to be get in terms of the sales for in India, and 10 rupees of each unit into 800 rupees, that is 8,000 rupees of the amount they can expect. So that total 63,000 and 8,000 is equals to 71,000 rupees of the sales they can expect this one. And material cost. So 21,000 rupees of the amount they are incurring for that product, means 21,000 21,000 divided by 4,200. 4,200 means 21 ones are 21 twos are. 2 divided by 10 means 5 rupees. So each material cost is 5 rupees here. And so each material cost is 5 rupees means here 800 number of units means 800 into 5, 4,000 rupees. 4,000 rupees. And wages, 12,600 rupees is the amount they are spending as an wages for 4,200 means. So that 12,600 divided by 4,200 number of units, that is equals to 42 42 3s 126. Each unit price, their labor charges they are paying is 3 rupees. So that for 4,200 they are going to be spending 12,600 means for the 800 units they are going to be spending 800 into 3, that is 2,400. They're going to be spent. That is total equivalence to 15,000 rupees. And variable cost of 50 paisa per unit, that is 2,100 rupees amount they have given. And here 2,100 divided by 4,200 means 21 divided by 42 means 1 by 2, that is 0.5 rupees they are spending for that variable cost. So that it is equivalent to 2,100. 0.5 into 800 means 400 rupees they are spending as a variable cost. And that too, freight charges only for Sri Lanka additionally they are paying 0.25 rupees per unit means 0.25 into 800 number of units, that is equals to 200 rupees. So the total marginal cost of this total element will be 35,700 and here it is 7,000, that is equals to 42,700. And if we less this sales minus the marginal cost, then we will get the contribution value. Contribution is from the from India they are going to be get the contribution of 27,300 and 1,000 rupees as the contribution from this Sri Lanka. And if we less this fixed cost 7,000, they are going to be get a profit of 20,300. And for this Sri Lanka, if we have seen this one, 1,000 rupees are only the benefit contribution from that particular unit out of this 21,300. So it is advisable to try for the Sri Lankan market at rupees of 10 rupees per, as by doing so that it can increase of 1,000 number of units. So 1,000 number of units there is a chance to increase that one with a contribution towards that particular product. So that is the analysis of this particular problem. Same one, if we see this next problem related such kind of break-even analysis. Asian Paints manufactures 1,000 tins of the paints when working at normal capacity. It incurs the cost of 16 rupees in manufacturing one unit, and the details of this cost are given below, with the direct material cost of 7.5 rupees, direct labor cost of 2 rupees, variable overheads cost of 2.5 rupees, and fixed overheads of 4 rupees. Production cost total is 16 rupees. Each unit of the product is sold for 20 rupees with a variable selling and the administrative expenses of 50 rupees per unit of production. That too, during the next 3 months, only 500 units can be produced and sold. Management plans to close down the factory, estimating that the fixed manufacturing cost can be reduced to 2,000 for the quarter. When the plant is operating, the fixed overhead costs are incurred at an uniform rate throughout the year. Additional cost of plant shutdown for the 3 months is estimated at 2,800 rupees. Express your views whether the plant should be shut down for the 3 months and calculate the shutdown points for 3 months in units of products. So here the information provided is the cost expenditures, that is a variable cost they have given, direct material cost, direct labor costs, variable overheads cost. So the total cost they have given, variable cost and the fixed cost per unit they have given, so that the production cost per unit is 16 rupees and the selling price per unit is 20 rupees. with a variable selling and administrative expenses of 50 rupees per unit of the production. So during the 3 months, only 500 units can be produced and sold in the 3 months. Management plans to close down a factory, estimating that the fixed manufacturing can be reduced to 2000 for the quarter. When the plant is operating, the fixed overcosts are incurred at an uniform rate throughout the year. Additional cost of the plant shutdown for the 3 months is estimated. Additionally, if they want to shut down to maintain that one or to keep that plant safety, additionally they have to pay 2,800 rupees of that amount. So that we need to give a detailed analysis to this particular organizations, whether is the decision of closing down for 3 months of that particular unit is beneficiary for the organizations or not. First of all, if we see this contribution statement of this particular given data, direct material, direct labor, variable overheads cost, and variable selling and administrative cost in this additional data they have provided, so that the total marginal cost or the total variable cost is 7.5 plus 2, 9.5, 9.5 plus 2.5, 12 plus 0.5 means 12.5 rupees. Whereas the sales of that particular selling price of the each unit is 20 rupees, means the contribution of this each product is 7.5 rupees. And next one, we will see whether the organization is getting the losses or not with the operating of the profit, operating of that particular plant with the 500 units they are all producing. So contribution per unit is 7.5 rupees, means if they are all producing 500 number of units, means the contribution of that particular product is 3,750 rupees. And to meet this fixed cost for this 3 months, total fixed cost is 10,000, and it is going to be operating for 3 months or only, means out of this 3 months of 12, it will be, because it will be fixed cost will be calculated as 10,000 rupees. Expected cost on the operating is contribution of 3,750 minus fixed cost 6,250, because they are going to be using that machinery for the entire year. 6,250 is the contribution of that particular organization. Contribution of loss if the plant is shut down means unfavorable fixed cost of 2,000 additionally, and additional cost of shutdown 2,800, and total loss on the shutdown is 4,800. So from the above calculation, it is clear that in the interest of the company, it is better to go for the shutdown only, because they are not going to be get the benefit of this one. Additional, they are going to be paying 6,800 rupees of that expenditure on that one. Then if they shut down this one, so have to see this one. Avoidable fixed cost for this period, total fixed cost of the period minus unfavorable fixed cost minus additional cost of the shutdown. If we have seen, the total fixed cost is 10,000, and additionally the 2,000 rupees of that one if they wants to avoid that one, and 2,800 rupees of a cost which is incurring for that shutdown. So that they are going to be have this 5,200 is the amount fixed cost, 5,200 only the fixed cost, because if they shut down this one, they need not to spend this 10,000 rupees. So shutdown, at this shutdown point, avoidable fixed cost divided by contribution per unit if you have seen, and they are able to have the benefit out of 500, 693 number of units they are able to sell. So that's way it is better to go for the organization's interest of shutting down this particular organization to get the maximum benefit out of this one. So that is about the analysis for calculation of break-even point, and in terms of the units or in terms of the sales for the various problems at the various given data that I have discussed with you. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.